I'll give a thank you, Marty. It's great to be here and great to be with his panelists. Brian, we'll have to talk separately because I also joined cross country recently and had a very similar experience. And before I get into any private equity items, I do want to say that I did attend an in-person large event last night, which was my first in-person large event attending like in a year. I've seen people obviously, and I am exhausted. It's really hard to talk to people in person for an extended period of time. I think I thought I would be more used to it or get into it a little bit more, but it takes time. So I don't know. On occasion, I kind of like working from my nice home office and just pressing buttons and talking to people. So we'll have to think of a hybrid approach, as is private equity. So real quickly, just a little introduction of myself before I turn it over to other panelists. I head up the private equity practice for Cross Country Consulting, which is one of the largest specialized finance consulting companies in the country with over 700 consultants. We work with investor-backed companies on all Office of Finance, Office of CFO initiatives, accelerating the financial close process, introducing KPIs, automating accounting, cash flow analysis, 13-week cash flow. We work with that. So most of the folks on this call that have investments in some capacity, we've probably done some work to help support and enhance that finance function. Would love to talk about it more. It's a great company. I'm enjoying myself. It's good to be here. I do work with a lot of different private equity firms, so have some insight onto what they're looking for, things they're thinking about, roadmaps, how they do diligence, which we'll get more into. Thank you. Charlie or Michael?
Yeah, sure. Thanks very much. So great to be here, as I said, and thanks for having me in the panel. I really appreciate it. And to this point, it's an interesting story just from the beginning of the pandemic. We closed a deal on March 2nd, our acquisition of Midwest GAN. We had celebratory drinks as the firm that evening, and that was the last time we saw everybody in person until just a couple of weeks ago, and it was great to finally be able to see a lot of our colleagues in person again for the first time. Actually, on the road at a management meeting, it feels like we're returning a bit back to normal. And by the way, I apologize in advance that I'll need to drop off at 10 a.m. But just a little intro here. So I'm a principal at Argand Partners. So Charlie Burns. We are a New York and San Francisco-based middle market private equity firm. We target market-leading industrial companies with really under-resourced and under-realized global growth potential. Our companies have strong market share, sustainable competitive advantages, defensive characteristics, and significant growth potential supported by secular demand trends. The firm focuses on advanced manufacturing and also business services. These companies they all have a strong U.S. nexus, whether that's headquarters or significant operations or primary growth market, but they often have a global footprint or global operations or expansion opportunities. 5 of our 6 portfolio companies have significant operations outside of the U.S. Argand is a value-oriented control investor. We seek complex and often contrarian situations, really in order to buy in well. But we really enjoy a hands-on approach with partnering with management to create value across the investment lifecycle and to help portfolio companies achieve their full growth potential in world-class industry-leading companies. Thanks very much. I'll hand that off.
Good morning, Michael Smart. I'm happy to be here. Typically, I'm sitting in the audience, but Marty cajoled me to sit on a panel this time around. It's really interesting. There's a recurring theme here of people sort of joining the firms during the pandemic. I also happened to join Dominus during the pandemic. We actually entered into discussions about my joining in February, March. The pandemic hit. We sort of reconnected again in the fall, and I joined officially in December of 2020. So although I joined them officially in 2020, I've actually known the partners for in essence of 20 years. They're former clients of mine. I worked with them and they're spinning out from their former firm, Quad C. So have a great deal of connectivity and affinity to partners for long duration. Dominus is an operationally focused middle market private equity firm. We manage an essence of approximately 1.3 billion in capital through 3 funds. We focus primarily on business services like manufacturing and niche consumer branded companies. We typically spend a great deal of time, and I guess it's based on our backgrounds, a great deal of time with family owned or founder owned and run companies. Approximately 75% of the 80 companies we've acquired during our existence have come from families and or founders. So very excited to be a part of this panel, given the audience.
All right, thanks so much, everybody. I'm just going to take over for a second. I'm going to call a little audible on everyone just because of the time, and I know that Charlie was really interested in talking about what I had as number 3 on our outline. So I want to make sure that we get to that before he has to depart at 10 o'clock. And just for everybody's benefit in the audience, the 4 of us had a great conversation yesterday. Really interesting stuff. And I think that the trends that we talk about in private equity, both what's going on now and sort of how COVID has affected everything and what things we're seeing changing will be really interesting for all of you. So, you know, the topic I want to get into, the word frothy kept on coming up in terms of describing the markets that we're operating in right now. So this part of the conversation will sort of be a discussion of what today's markets are looking like in private equity, what types of opportunities people are seeing, what's interesting to everybody, and then how people are actually executing on deals right now and whether things have changed or whether we foresee them as changing more going forward as we emerge from COVID. So I want to turn it over to Charlie and give him the opportunity to talk about all of those things before he has to go.
Yeah, appreciate that. Thanks very much. And yeah, happy to kind of go back and forth with everybody and make that a conversation. But you know, to your point, it was an interesting conversation. Just hear how things kind of developed from kind of through the pandemic and now kind of leading into today. You know, during the pandemic, clearly there was a period where the market just stopped. You know, we really weren't seeing a lot of activity, and that was kind of that. I'd say 2Q of 2020, but the back half of the year was really strong and a whole ton of activity. Fortunately, we were able to acquire both a platform, you know, our 6th portfolio company, and also a company doubling deal for our 5th portfolio company, the one that closed in March. So the firm was quite active beyond a lot of other things going on in COVID, which we can maybe touch on a little bit later. But so I'd say we were active on the investment front, but now kind of the new deal activity has really returned with Augusta. I'd say we, as I mentioned, we're now at management meetings, kind of returning to normal, and something that feels that we're seeing is it's almost as if there is like a double period of selling where a lot of those processes or people, you know, founders who were thinking about selling last year and pulled back because, you know, there was a lot of uncertainty, now are you know, ready to sell their company amidst the same time that those who normally would have been selling in 2021 are also selling. So there is a ton of activity, you know, and that really leads to people picking and choosing their spots. So, you know, in talking with some of our intermediaries, what we're hearing is they're seeing a reduction in the number of groups that are responding to the companies that they've kind of put out for sale. But where there are responses, you know, they're seeing 1 to 2 turns increase in the EBITDA multiple that's being paid for companies. So that kind of gives a sense of how people are triaging with just the level of activity you have, and finding where you're willing to go, and really leaning into whatever deal that you're going for. And we're obviously still kind of maintaining our discipline. So it's I think there'll need to be some froth that washes out and allow us to kind of participate. But something we're also really leaning on is prior relationships. Helping to choose those spots is the fact that you've kind of interacted with those management teams, or those founders, or those companies kind of many times throughout the year. And Lachlan, you want to talk a little bit about maybe what you're seeing too?
Sure, I would agree with you, Charlie, to a very large extent. When you take a look at what occurred during the pandemic, effectively, all the businesses, business owners or intermediaries who had planned on putting companies on the market during 2020, for the most part, many of them sort of stalled. So you had sort of that back up on the runway. Now that things are opening up, you sort of double down on the fact that those who actually planned on selling their businesses in 2021, this fiscal year, they're sort of getting into Q2. So you could imagine sort of an airport, typically LaGuardia, during the summer months. And there's just a long line of deals just sort of launching processes. That's one. Two, there's been all the discussions surrounding the tax changes, and we've always had those types of discussions in Washington. I think the consensus is something actually would happen during this administration. So many owners, many families they're considering sort of selling their businesses at this time. So that also increases sort of the amount of transactions or potential transactions in the queue. Like Charlie, we there was sort of a pause somewhat last year. On the deal side, we were very fortunate. I think just given the way we approached the market and who we market to, able to get 2 transactions done from 2 sort of founder families during the pandemic. And to Charlie's point, in this fiscal year, we are seeing sort of valuations become a bit more aggressive, I think everyone needs to sort of maintain their degree of discipline, and I know we are. It sounds like you guys are. I think in certain cases we may look at similar businesses, but deals are getting done because I think you also have some of the larger buyout firms sort of coming down market in paying that extra turn of EBITDA for companies that are for sale.
Yeah. I would say, Charlie, I know you have to head out in a little bit, but it's incredible. Some of us got new positions in August 2020. There's more dry powder than there ever has been. Funds are raising at record paces. Multiples continue to go up. How is this happening when we've just reemerged from a pandemic? So the resiliency, not only of the US economy in general, but of private equity strategy, to me, has been absolutely shocking. And whether that's due to technology, whether that's due to the fact that maybe you don't have to meet management teams as much in person during due diligence, that you can coordinate a process and run companies remote. Private equity firms have always run their companies remote. They don't acquire companies in their geographical location. So they're used to this. And they've been able to perfect this over the last year. I think one last point is that the issue that has been brought up is things are too expensive. multiples have gone up. How do you do deals? So what we're seeing from our private equity clients and prospects is they're willing to pay up for platforms as long as they have a great inorganic growth strategy. Okay, you can't keep multiples at 10 to 20 times cash flow forever. So you can pay that initially, acquire things at a diluted ratio, integrate those efficiently, and run those remotely. That is a strategy for success, because as interest rates go up, tax rates go up, returns go down. So I don't think that that's going to slow the deal flow. I do think that it potentially could decrease or diminish IRRs. So you have to have a strong inorganic strategy to make some of these things work.
So I everything you just said, Ben, I love. I do want to give Charlie another couple of minutes to say one last thing before I get into the next topic. I think a really good transition here would actually, based on what you just said, in terms of potentially, lower returns as a result of interest rates going up and tax rates going up, is what are we doing as private equity managers at our portfolio companies right now, and what's changed as a result of COVID? How are we becoming more efficient? And is it possible that those things might offset the types of risks that you're talking about in terms of the increases in rates and taxes and potentially other headwinds? Charlie, you want to talk to that a little bit?
Yeah, I'm just thinking a little bit about what has changed with our companies, and frankly, to Ben's point, not a lot has changed in the way that we interact with them. This is we've always had our weekly check-ins with them and our daily calls, frankly, with some of them when you're working through something with the company. So that type of remote interaction was always there, and we've continued to do that. There were different challenges that they had during COVID. First it was, COVID hits, let's make sure that there's ample liquidity. Let's make sure we have all of the right health and safety programs in place. Let's be their excess kind of management capacity and helping think through challenges like, can I be an essential business and stay open and function? We're kind of there as that extra capacity for them at times, but we were always there for them for that. To your point about rising interest rates, I would, it's kind of our view that the lower interest rates help elevated asset prices historically, but again, we kind of find ways with complexity in those companies or global nature of them so that it's a kind of a limited competition set and looking to buy them anyway. And also leverage while we employ it. We kind of don't take every last dollar worth of leverage for that. So it's I can see it impacting the market, but fortunately it hasn't touched us as much as it may has for others. Maybe with that, I'll hand it over to Michael and really all needs drop. So I appreciate you invite me on the panel and give me a chance to talk to the audience.
Great. Good seeing you, Charlie. We'll catch up later.
Absolutely. Thanks, everybody.
To Charlie's point, we've always, private equity firms have always operated remotely with many of our portfolio companies. I think, but you have to sort of look beyond that and how the portfolio companies actually operate, because that's where the rubber meets the road, frankly, and that's where the returns are created. We have an operating orientation. In fact, we've got 6 operating partners and/or advisors as part of our firm who work exclusively with us. With that tool in our toolbox, we're able to sort of help our portfolio companies sort of position themselves to better survive the pandemic. To Charlie's point, making sure that they have the right equipment, making sure that we can be sort of certified in as an essential business, because in many cases everything pretty much shut down at the very beginning. It was key to be able to position your portfolio company to open back up to the extent that it could, that when it does open back up, that it's in a safe position. All of its employees are in operating safely. that they have the tools and equipment to operate effectively and efficiently in a new world order. So that's sort of that's the issue you really have to sort of focus on, because to the earlier point, yes, we're sitting in New York, we're sitting in San Francisco, we're sitting in our home, and we're having conversations with the CEO who really has to make things work. So we focused on making sure that he or she has what they need to make things work. And we were very, very fortunate to sort of come out of the pandemic with not needing to put any additional capital into any of our portfolio companies, and frankly having a big tailwind in front of us in terms of sort of the pent-up demand for the various products and services that we offer. We own a barbecue grill company, so as you could imagine, everyone's at home, everyone's cooking, everyone's outdoors. So that seemed to work out very well. Okay, well, you would assume, okay, well, you guys are fine. The issue from our position, from where we sit, is to make sure that the manufacturing and supply chain was operating efficiently. So that was sort of one of the focuses. So sitting in New York is fine. We do that all the time. That's the way we operate. Although we do spend a lot of time with our portfolio companies, it's just making sure that they have all that they need to continue running their operations efficiently and effectively.
Yeah. One comment, Michael, is it's interesting. I didn't realize how many operating partners or that role that you had at your firm.
Yeah.
And I think that's one of the biggest evolutions in the private equity industry is the use of operating partners. I mean, they have previously been called executive residences, maybe, but now they've been brought in on staff. And, that's who we work with the most. And I can tell you that firms are changing their strategy on how they're hiring, how they're compensating, what the roles of those operating partners are. And probably this environment has matured that level to an extent that has been maybe more accelerated than others. You're right. An operating partner has to have some relationship with the CEO, the CFOs, the C-suite of those companies. And it's more than just the financial information. It's the culture, and especially culture in this environment and the culture of doing acquisitions and taking on new initiatives. So I think that's a really important role. Marty, we should have a separate panel on the operating partner role for private equity firms.
Yeah, it's funny that you mentioned that. I've noticed it with a lot of our clients. They use the model too, and I didn't give a lot about my background before I went to Morrison Cohen. I was at a company called Hedgemark, which was a managed account platform for large institutional investors, mostly in the hedge fund space, actually, some private equity strategies. But prior to that, when I was in private practice at another law firm, I didn't think that the operating partner concept was as prevalent back then as it is now. Now I have several private equity manager clients that use the model, and now I hear all of you guys talking about it, and it makes a whole lot of sense to me. So I agree with you, Ben. It would probably be a good topic for further discussion, maybe at the next event in Baltimore. The other thing I wanted to comment on that you said, I loved what you talked about, how reemergence is exceeding expectations. And I've been saying it for months now. I kind of feel like we're in for another roaring 20s right now with the way that the economy looks like it's going to boom after everybody starts really getting back to normal, going out and doing things. And most people respond to me that at the end of the roaring 20s, there wasn't such a great old pot of gold at the end of that rainbow. And my response to that is always, yeah, but we went through that in 2008 already. So I think we're doing it in reverse this time, and we're just in for a good ride right now. Any thoughts on the 1, 5, 10-year horizon in the private equity world, thinking about how good things can be with everybody's demand just to get back to normal and really break out of the prison that we've been in for a year and a half? Michael, you want to take that one?
Sure. From our perspective, look, you look at the private equity industry from a historical perspective, and you can apply those same principles going forward. We've always been extremely resilient and adaptive to the various cycles within the economy. If those firms, those managers who aren't, they're just not around anymore. So when you take a look at firms that have gone through 2008, gone through the tech bubble, has gone through 2016 and 17. Those firms have been able to adapt and adjust and move forward and take advantage, frankly, of those blips, those downturns in the economy. And we've been very fortunate to do so. I mean, we were formed in 2008. Probably not the best times to be starting a private equity firm, but we're still here today, and manage three funds. I mentioned currently our third fund in the $400 million range. So I think success begets success, and the important thing is to not just be inward looking, but also be outward looking. And I think the way we're structured, sort of having the four financial partners like myself, and having the six operating partners / advisors, out in the marketplace, that gives you a different perspective on the economy. So we think that the industry in general will be able to weather that storm in the next 1, 3, 5 years. It's all about adapting and being resilient and adjusting to the economy that you have before you.
Yeah. Thanks, Michael. From my perspective, yeah, I don't know what's going to happen in a year. I don't even know what's going to happen next week. So, maybe there's another pandemic. So, who knew anything that's going to happen? Here's what I think. I think that as long as other asset classes don't return capital or return of any significance, there's going to be a place for private equity. So you can read Fed minutes, you can figure out what they're doing. They're keeping interest rates low for some period of time, even if there's some level of raises going on. So the bond market and other asset classes are still going to have low returns. There'll be a craving for private equity returns. As long as there's a craving for private equity returns, LPs will continue to pump money into funds. As long as they continue to pump money into funds, there's going to be a place for private equity. Okay. Because it really doesn't matter if you buy something at 10 times, 12 times, 20 times, or 100 times, as long as you can sell it for 105 times, or you can create value so that you're increasing your base, you're going to be in good shape. So I don't see that ending anytime soon, which is why it's a great area to be in at this point in time.
Excellent. Thanks, Ben. So I actually just noticed we have a bunch of questions in the chat that I hadn't seen before. Marty, so I think we have 10 minutes left. And we had one more sort of item on our own agenda, just to talk about regulatory stuff in the PE world, the change at the SEC. I could just talk about that for 2 minutes quickly by myself, just because we don't have a lot of answers yet. It's just the things that I'm thinking about right now. And then we could get into some of those questions. Some of them I think we've answered already. But the others are interesting. I hope it's not too big a deal if we go over by a few minutes. With respect to the regulatory environment, I'm sure everybody's cognizant of the fact that there's been a change in the administration and a corresponding change of the majority of the commissioners at the SEC. And Gary Gensler is the chairman, is the chair now. So there will be differences, and none of us know what they are. I apologize. That's my wife in the background. sorry, hold on just one second. That's Roxy and Ranger also, by the way, the joys of working from home. There will be change, and most of us look at it as sort of a thematic change from the previous administration being in more of an enforcement, prevent wrongdoing mode versus the new administration really trying to get regulation out there, and potentially changing things that were just recently changed. And it's all extremely interesting to me at the moment. A couple of things that that I'm focusing on, one of which might be interesting to this whole community. I got a lot of questions when I rejoined the firm about the opportunity to be compensated for making introductions. There is a finder's exemption to broker-dealer registration that people had relied on for a long time in order to get paid for potentially introducing an investor without really serving as a broker-dealer. And interestingly, at the end of last year, there was a proposal for actually codifying that exemption that people relied on. This is just an example of the type of thing where there was a lot of hope in the marketplace that they would do something like that to make things a little bit more predictable. But I think most people now predict that that will either fall by the wayside because it's just not going to be a priority to enable people to do things that could potentially harm investors, or potentially even have specific language coming out of this new SEC saying that you shouldn't do the things that people thought were permitted under what's called the Paul Anka letter. And I'm happy to talk to you guys about that more individually if you have questions about it, if it's something that's a live opportunity as you're networking with your colleagues. Other things that really sort of struck me about Gensler's priorities is in the cryptocurrency and DeFi space, which I know you'll be talking about a lot later today, but people have been extremely eager for rulemaking in that sector as opposed to regulation by enforcement, which is what's been happening and leading to a lot of, I would say, stifling of innovation in a really interesting space right now, some space that might be interesting to family offices and to private equity managers, seeing as a lot of the tokens themselves that are being offered are illiquid and might be ripe for private equity investment. So those are just things I'm focusing on from a regulatory perspective. I have my eye on it all the time. I'm constantly looking at rulemaking, getting updates from the SEC, not so much relevant to this crowd, but the CFTC also. If anybody wants to talk further about that with me, I'll put my contact information, my bio into the chat so people could see it. And I'd love to have more detailed conversations. But let's go back to some of these questions. The first one was about interest rates impact, which we talked about. Frothy pricing for acquisitions, I thought we talked about. So the first one, how many purchases go to auction? Michael, Ben, do you want to talk about that a little bit?
I would say, the majority of them, frankly, will have some form of intermediary involved. The issue is how much of a process is the seller sort of taking the business through. You can have very, very broad auctions where they're sending excess of 50, 60, hundreds of books out to people like ourselves. You can have sort of select processes or beauty contests where you have a significantly smaller number of potential buyers. And then, to a certain extent, you can find a business, you build a relationship with them over the years. They decide that, we really like those guys, those buyers. We like how they approach growing businesses, and it's not just tied to M&A, it's also tied to operating enhancements, that they are good partners to work with. Even in those cases, they'll typically have some form of advisor. So they'll have their legal counsel act as an advisor, or they'll bring in a broker, sort of regional broker or banker to assist in the negotiation. So there's always someone involved. nothing is going to be, free unless you've built that relationship over the years, and you've discussed sort of pricing and structure and the growth and the next steps and how you partner with someone. But typically there'll always be someone involved. We've been fortunate that probably, in excess of 50% or so of our investments have not been broad auctions. And again, that just speaks to our approach to the market. So we'll attend them. We're not necessarily buyers in the broader processes.
Yeah, I don't have much to add to Michael, except that, God, if somebody could think of the secret sauce for proprietary deal flow in this environment, they would be able to join any private equity firm in the country. So really, really, really hard. I don't even know what the definition of proprietary means anymore, because somebody's going to have an advisor, a lawyer, a broker, and probably maybe that's the best thing to occur to make the market more efficient, but it does raise prices.
Yeah, I mean, again, proprietary is a very broad term.
Yeah.
I think it depends on just your focus and your emphasis and the types of business that you're looking to acquire. So it could be proprietary, but there's always going to be, my brother-in-law is a lawyer, or my son is a banker, and you bring them involved, but that's sort of a separate universe to the broader processes where you've got a Goldman Sachs or a Harris Williams involved. And those are the situations that we actually like to focus on.
Right. There are still a couple more that I think are really interesting, actually. The first one, and we probably don't need to spend a lot of time on, are SPACs viable competitors to PE? And I actually have some thoughts on this. I mean, they're two different things, really. So I wouldn't consider them competitors. SPAC is to acquire a single company, whereas private equity is, in terms of fund formation, at least, is having a lot of dry powder to acquire multiple companies over time. For a SPAC to actually launch, do an IPO, and acquire a company is actually a very intricate and time-consuming process, whereas PE is a little bit more nimble in terms of being able to acquire a company quickly if need be. And there was actually another question about whether there's a silver tsunami of boomers looking to sell their businesses, which I think would be interesting to parlay with this question, because I know Michael and Ben do have some thoughts on that. So no, I don't view them as competitors. I view the SPAC market as really interesting right now and a great way for companies to access public markets if it fits, but I don't view it as competition for private equity sponsors or investors that are looking to make acquisitions. Any thoughts on that, and particularly on the nimble point with respect to sales of businesses now?
No, I would agree that private equity is a more nimble, flexible buyer of a property. But in some respects, SPACs actually are competitors because you're basically competing against pools of capital. And although a private equity firm is managing a fund, which is a portfolio of investments, we may compete with that SPAC as relates to a specific property in a certain sector. So that's sort of where the competition comes in. The advantage of private equity relative to a SPAC is, again, to your point, the flexibility that we have in our inherent model in terms of our ability to get a transaction done relatively quickly. So the SPAC, is going to compete, one, frankly, on price in many respects, and if they have the relationship to sort of, take the business off the market relative to a comparable private equity buyer who can write a comparable check.
Yeah, I know we're running out of time. The problem with SPACs is they're public. So, being a public entity is a lot different than being a private entity. Requires more oversight, some levels of less flexibility. et cetera. So it'll be interesting to see. I mean, SPAC's been around for a long time. It'll be interesting to see what the last year, let's look 5 years out and see what the returns of those SPACs have been, who has actually made money. Was the SPAC formation entity, or was the actual people who invested in the SPAC afterwards? And then we can answer that question of how it differentiates between private equity.
Yeah, I like that response, Ben. And I think SPACs are good fits for certain type of companies, and PE are good fits for other types of companies. The recent Topps deal with Mudrick made a lot of sense for a SPAC. Topps is a huge company. Topps has an enormous amount of publicity, and Mudrick is a big name in the hedge fund space. It all seemed to fit, and it seems like it's working very well. But and I agree with you, Michael. Sure, there's if there's multiple bidders on a target, you might see SPACs in there, you might see PE in there. But I agree with Ben. It's really a different business model. It's a totally different product, and the distinction between being a public company versus remaining a private company is a fairly material one. So I guess to sum up the answer to the question, yes, there is competition between the two, but in terms of, it depends on what the question means. If the question is whether SPAC is a viable competitor to PE in terms of, SPACs replacing PE in the marketplace, then the answer is no. But yes, there is competition for deals, certainly. Marty, how much time do we have time for one more? Because I like the last question about how family offices can work with PE firms as co-investors or LPs. Of course, I'm seeing a lot of that in the marketplace right now, but I'm a lawyer. You don't want to hear from me. You want to hear from Michael and Ben on this one. So guys, have at it.
Sure. Ben, you want to go first, or?
I'll leave the last word to you, Michael. How can family offices should be co-investors to private equity firms? It's a lot easier than being a direct investor. So if they can leverage off the Michaels of the world and get some level of economics, I'm not speaking for your economics, Michael, but you can get some level of economics, then I might start my own family office, because that's a pretty good deal. It's hard to do. Hence having those relationships, having a level of capital that you can group up with quality private equity firms like Michael's, and to be able to get quality deal flow. So, I would say go for
it. Thank you, Ben. We're very fortunate, very blessed, frankly, in that we've incorporated co-investing within our model. So for just about every dollar that we put to work, there's probably about 35%, 35 cents, allow for co-investing. And we offer that co-investment across the board to all of our investors. Sort of, just inherent in our document. So, I should have managed that process. So whether you're managing capital for a family office, or you're, the state of New York, everyone gets their pro rata share, or at least they're offered their pro rata share of that co-investment. And we actually have a relatively balanced group of investors. About 40% of it is from Europe, the balance here in the United States, and we have family office money or family money from both pools. So we're very fortunate in that respect, and we're experiencing sort of managing that universe of institutional investors and offering them co-invest.